My name is Rod Turner. I'm the CEO and founder of Manhattan Street Capital. And with me in this webinar presentation is Sarah Hanks, who you can hopefully see on your screen. Sarah is very knowledgeable personally, and her company is very well known in our industry. She knows about the regulatory environment very well, and is also pioneering understanding the application of the regulations to initial coin offerings. So we're very fortunate to have Sarah with us. Thank you, Sarah. So I'm going to talk a little bit more about our intentions for this event and set the stage, and then after I've spoken, she'll present as well, and then we'll take questions and answer them as best we can. We did another event like this in November, and like this one, we expect it to run a little long because of this subject. And unlike last time where we were unable to make a video recording, in this case we have two methods in hand making video recording. So my plan is to make a version of this video available to all of those who have booked attendance, where it'll be indexed, and you can click to the parts that matter to you most and watch those parts. So Manhattan Street Capital, we are a funding platform and a consulting company that help companies that want to raise money using Reg A Plus and Reg D and Reg S vehicles. And now we're helping companies do initial coin offerings which are compliant to the SEC regulations. And we are dealing with a lot of companies. We have an interesting funnel of more established companies that are planning to do initial coin offerings. So we have some practice in the issues that matter, and we want to help inform you guys with this webinar about those issues. We are not soliciting you guys to do ICOs. We're just helping inform you that if you want to do an ICO, you want to make it SEC rules compliant. We're providing you guidance today as to how to do that. We're not trying to suggest that you should do an initial coin offering. That's for you to decide. My primary points here are the following. There's a lot of confusion about, is my initial coin offering a token? I'm sorry, is it a utility token or is it a security? And I have yet to have a discussion with a company where I can convince myself that their ICO is a utility. But I have my own rather straightforward approach to it, which is the following: that if the intention is to raise money by selling tokens through an ICO, and if the intention of the investors if the intention of the people buying the tokens is that they expect those tokens to increase in value over time, then this is, at the end of the day, an investment. It's a security of one type or another. Another way to look at it is, if it was truly a utility, then you would probably establish a fixed price for it and give it away free, or charge a fixed price to use the token, and maybe you can users of the token can earn money from it. But at the end of the day, it's a pretty simple thing, that if you're selling tokens to people who are buying them because they think they'll go up in value as a result of your efforts in building your business, it's a security. And there isn't any way to get around that beyond not selling your security to US investors, not operating in the US, or doing it through a security compliant offering. With that, I'm going to ask Sarah to make some remarks. And again, Sarah, thank you very much for participating.
It's a pleasure, and thank you very much for including me in this. It's one of the most interesting things I've come across in 35 plus years of practicing securities and corporate law. As Rod had mentioned, we're going to have plenty of time for questions, and so I just wanted to give you an overview of some of the things that you really need to take into account in doing an ICO that involves securities. I'm not going to get any further into the is it a utility, is it a security than Rod did, because I'm coming at this from the point of view where you've got a Securities and Exchange Commission that says pretty much everything is. And as we see yesterday with the lawsuit that was filed against Caviar, we've got state securities regulators who think that probably even more. So how do you do it right? One of the most important things that I've seen in coming across some of these offerings is number one, corporate formation. Never issue securities without organizing yourself into a company. Limited liability company means that you limit your liability. Same for a corporation. You should not be doing this as an unaffiliated, loose team, because to the extent that it's just a bunch of guys who are getting together and putting together a token, you'll probably get treated as a general partnership, which means each and every one of you is responsible for any of the stupid stuff that any one of your friends did. So don't do that. Take care of the corporate niceties. Organize yourself as a company, either a corporation or an LLC, and make sure that you follow the rules under whichever state you've incorporated or organized with respect to how you are supposed to issue securities. In other words, don't do this without a lawyer. With respect to creation of the securities, a token essentially is a bundle of rights, the rights and privileges in the venture to be funded with the proceeds of the ICO. And so those rights have got to be recorded somewhere. Probably not in a smart contract, because most of the ERC20 contracts I've seen, you don't have the ability to put all of those rights in that contract. So you've got to have an instrument whereby it is written down what the rights of the token holders or coin holders have. And then if there are elements of equity in that, so profit sharing, you're going to share some of the money that comes in or share some of the profits. If the securities look like an equity security, which involves a vote or profit sharing, then you want to make sure that, again, you've followed the corporate niceties. If you're incorporated in Delaware, you follow the laws of Delaware as to how those securities get created and where you write them down and how those things are recorded. So bear those things in mind. Securities law principles are one of the most interesting things that we're seeing right now in terms of securities law, is this whole kind of jurisdictional issue. Shall we all go to Cayman and set up a company in Cayman and sell the securities from Cayman? Well, I mean, you might be able to do that. Or you could go off and go seasteading and issue the securities from the middle of the ocean. But the moment you come back here and start managing that process, you have now given the SEC or the state securities regulators jurisdiction. So how does the SEC get jurisdiction? Anybody who uses the so-called jurisdictional means, like the means of communication across state, the telephone, internet, television, radio, whatever. If you're using any of those means, the SEC probably has jurisdiction over you. You're not going to be able to escape from SEC jurisdiction just by forming a Cayman company. The other thing to bear in mind with respect to jurisdiction is state jurisdiction. A lot of states will have jurisdiction over your offering if you are located in that state, and you're even if you're not offering to people in that state, if you're offering from that state. So again, it's different from state to state, but most states will have jurisdiction over your offering if you're offering in or from that state. So bearing those things in mind, what laws are going to apply to you if you're doing coin or token offerings that are securities? The Securities Act is the big one for most of our purposes here. The Securities Act regulates offers and sales of securities. And what it says is, if you are offering or selling securities, the offer or sale must be registered under the Securities Act or made in accordance with an exemption from the Act. Bear in mind that the term offer is very, very broad. You can have an offer of securities whenever you're just promoting it. You go on a radio show and you say, oh, by the way, we're thinking of raising some funds. Haven't done anything yet, but the token will be called caviar, for example. That's now an offer of securities. The term offer is very, very broadly interpreted by the SEC. Another thing to bear in mind is when we talk about sales, a lot of people will be going, well, I'm not selling anything. I'm giving this stuff away for free. And again, the securities law treats that very, very broadly. If anybody, if you are giving tokens to people because they are paying you money or doing a thing, blogging, posting on Twitter, whatever, that is going to be treated as a sale of securities. So bear those things in mind. There is no such thing as free, and everything is an offer. So the options that we have for the various types of offering in general are Regulation D. And Regulation D, you have to sell to accredited investors. With respect to the accredited investors, you are going to have to know that your investors are in fact accredited. They can't just check a box, because the rule that the specific rule under Regulation D that we'd be relying on here is 506C, and that's the one that says you can advertise, you can publicize your offering, but the price you pay for publicizing your offering is that you have to make sure, you have to take reasonable steps to verify that the investors that you're selling to are accredited. So that's your Reg D option. Regulation S is being used by quite a few ICOs, and they're mostly not quite doing it right because a couple of issues, I'll talk in a second about the state preemption issue. But Regulation S in effect says securities offerings don't need to be registered if they are outside the United States. And then it goes on to say, this is what we mean by outside the United States. And that involves not advertising in the United States, not having unrestricted websites that US investors can access. And it also involves getting certifications from people that they are not either in the US or US persons. There's Regulation A, working on a couple of those at the moment, one of them with Rod. That's for offerings up to a limit of $50 million. That has to be reviewed by the SEC, and we can expect that when they get these filings, they're probably going to spend a lot of time reviewing just to make sure that they understand that all of the risks have been properly disclosed to the potential investors. Good thing about Reg A is that you can sell to anybody. Doesn't have to be accredited investors. If you sell to folks who aren't accredited, they can't spend more than 10% of their net worth or 10% of their net income on the specific offering. And we hope that they're not going to spend more than 10% of their net worth on ICOs in any case. And then the final one I wanted to discuss is Regulation CF, Regulation Crowdfunding. That's probably only useful in the ICO context for the early days, so-called pre-sales. When you're selling a relatively small amount that is limited to $1 million, an SEC filing is required, but the SEC doesn't review it. I mentioned pre-sales. Note that pre-sales are in fact sales. There's nothing magic about them. If you're selling securities, you've got to have an exemption. And very importantly, because we're seeing a lot of this at the moment, referral or bounty programs. If you're doing that, that is a sale of securities. Even if it's just so giving somebody some fraction of tokens for posting on their blog, that is a sale of securities. Therefore, that sale's got to fit into one of these exemptions that I mentioned. Another couple of things to note before we get into the questions. State registration requirements. I mentioned Reg A and Reg D. Those preempt state regulation. So if you comply with those requirements, you don't have to think about, well, is Massachusetts going to get me? Not the case for Regulation S. If you are selling securities and you think you're going to say, well, I'm selling outside the United States in reliance on Regulation S, check the requirements of the state in which you are operating. So you don't get caught like the guy from Caviar did. Other things that you need to bear in mind is that the anti-fraud rules apply to misleading statements made in any of these offerings. So if you say something that isn't true, you can get sued for it, even if you've complied with the exemption, doesn't matter. And then finally, looking forward, we've got all sorts of complicated securities rules that we might need to address, and that we're working with the SEC. We're talking to the SEC about how we go about addressing them. But there are regulations such as Section 12G of the Securities Exchange Act, which says if you've got more than 500 shareholders of holders of equity, then you have to register with the SEC and become a fully reporting company. How you measure that in an inherently anonymous system like a blockchain, we're working on that. This is all developing, and it's all a lot of fun trying to work out the solutions to it. And so, having given you just a brief overview, I think we'll be over to the in-depth questions, Rod.
Yes, thanks, Sarah. So there's a couple of things I want to clarify for the audience. One is that some of the people that I talk with are expecting that the SEC will rapidly amend the regulations to make ICOs easier, simpler, more straightforward. That is an unrealistic expectation. You should not make any plans or assumptions about that. And the truth is that some of the regulations, obviously they were written before ICOs existed, and some of their requirements are or seem to be arbitrary, and that's life. We have to live within these guidelines because that's the way they are. If in the fullness of time the SEC does amend them, that'll become clear when it happens, but we shouldn't depend on that happening any time at all, or certainly anytime soon. Another thing I want to clarify is that there's a lot of confusion that I see amongst people thinking that an SAFT, which is essentially a convertible note on the purchase of a future token, a token that doesn't exist yet, somehow is a solution in itself to the securities rules, which it is not. You are raising money through a convertible note that is very nicely crafted in the form of the SAFT or an SAFE, which is a more conventional form of the same document, but for an equity purchase. In either case, you're borrowing money from investors are depositing money with the company for a future event where their money will be converted, if plans develop as intended, into a token in this case. And they have to be done in a way that is securities compliant. So you aren't choosing between using an SAFT and using, on the other hand, Reg A plus or Reg D or variation of Reg D or extension to Reg D. You are choosing to use an SAFT at the front end of what is typically going to be where you would use an SAFT is at the front end, a convertible note at the front end of a Reg D transaction. So don't get confused and think it's either or. That's an important consideration. And another thing that I just want to clarify between Reg D and Reg S, some relative strengths and merits there, in anticipation of questions that we're getting on a regular basis. In Regulation A plus, Regulation A is now Regulation A plus, so there's a terminology issue there that people are getting gradually accustomed to. But in Regulation A plus, the concept of delivering the token later does not exist. So yes, if you think about it, the SEC through Regulation A+ allows a great deal of versatility in an offering, but you do expect that the security, in this case the token, is delivered upon acceptance of funds from the investor. So you can't do a delayed delivery of the token. That doesn't mean that the token functionality has to be version 6.0, but it does mean that if you are selling tokens, you have to deliver the tokens, okay? Reg D provides a very, Reg D is the only way in which, maybe I say only, I have to caveat that, maybe there's an exception I'm not thinking of, but in the main, Reg D is the only way in which to raise money now from investors through a convertible note that might be an SAFT for future delivery of a token. So if you're raising money today for a token you intend to deliver 6 or 9 months from now, you have to do it via Reg D. You can't do it via Reg A+. So those are important issues. Now, we had a logistical issue earlier where questions that were posed, which were being sent on to me, disappeared. Matt, I am still not seeing the questions from the audience. So if you could figure out a way to solve that. And those of you in the audience, in the event, in the worst case event that we lost your question, which I think is unlikely, but certainly possible here, then it's okay. I request you to send your question again, because I'm not seeing any questions at the moment at all. And this was my fault. We switched to a new webinar software environment. Good. So there's some questions coming up there which will funnel through. Matt, in the interest of saving time, please send them, if you can, to Sarah and to me, assuming that you can do that. Okay, so in a minute we'll get to those questions. I just want to review my own thinking to make sure I covered the ground here. And one other important thing, which I do want to make clear, is that we did a webinar, Sarah and I, in November, which was also very well attended, and we had a heck of a lot of technical problems with it, which is why we switched to this software. But nevertheless, the point is that some people left the webinar feeling like it was flat out impossible to do a securities compliant ICO. So I do want to make the point that we're at the leading edge of solving these problems, and there are solutions that are reasonable. I don't believe that it's possible to do a securities compliant ICO without some gray area in it. And Sarah can add to that, I'm sure. But the fact is that it can be done. It's being done by us in partnership with Sarah, and it's being done by others. So, but there are still some gray areas where we're getting advice from Sarah that these risks are reasonable and manageable. So I don't want you guys to believe that this is actually impossible. It's possible to do. That it isn't as simple as accepting money and doing an AML check in a Reg A+, though. There's a lot more to be done than that in order to make these offerings compliant. So let me just switch to find out what's going on with our questions. And Matt, I'm not seeing anything from you in our chat box. I'm going to switch over here.
I can see some of them, Rod, so I can take a couple of them if you like.
Yes, please go ahead, Sarah. Thank you.
So there's a really good question from Lou on bounty programs, yeah, I mean, we are in exactly the same place. Bounty programs, referral programs, whatever you want to call them, if you are giving people something that is a security in exchange for them doing something or paying money, then that is a sale of securities. They should be registered. And I think that right now, bounty and referral programs, I mean, if I was the SEC enforcement office, I would just be on one of those bounty or referral sites, token hunters, whatever, and I'd just be making lists of them and then planning to sort of go through them, say, oh, yep, that's a security, that's a security, that's not, that's a security, that's a security, and then just pick up the phone and call the company or issue all of their names onto one very big enforcement action. I don't see why they wouldn't be doing that, and I'm pretty sure the state regulators are. there's to go into one of the other questions about jurisdictional stuff. There's a couple of questions on the jurisdiction. If you want to avoid SEC regulation, just move completely. Don't use any of the jurisdictional means. Don't use the US telephone system. Don't use internet. If you're looking to be completely unregulated by the SEC, go somewhere where there aren't any regulations, and there aren't very many of those places right now. I don't know, North Korea, seasteading. I mean, not to be facile about it, but if you're a US person and you think that you're going to be ending up taking US money, you are going to have an uphill battle trying to avoid regulation altogether. And it's probably going to cost you more to go and build your seasteading village than it is to just comply with the US rules in the first place. So very difficult to avoid the jurisdictional means and the jurisdiction of the SEC and the states. Let's see. Somebody asked about, is there anything out there? I've seen two or three questions along the lines of, is there anything that's been approved by the SEC? We never use the word approved. There's nothing that I am aware of right now that has gone through the Reg A process and has been qualified by the SEC. We're working on a couple of them. They're taking a bit longer than we thought. But we do know that there's a number of Reg D offerings out there which are compliant. They have sold only to US persons, to accredited persons. So compliance, to build on something that Rod said, I mean, compliance is not impossible. And in some cases, it's actually easier than trying to avoid the regulations.
Sarah, let me comment here for a moment on something helpful, or that I'm finding in a number of instances. It's interesting to me. There are cases. There are two instances actually that I want to get at here. One is there are cases where companies approach us where they have a strong business and they're attaching a token to it in order to theoretically more easily raise money. And the point here is that a token that doesn't really relate to your business isn't going to help, and you're not going to have likely success with it. But it's also the case that in today's market, I mean, everything is shifting very fast, but nevertheless, at this instant in time, when you raise money in an ICO, the large majority of that money is coming from people that are an unusual mix. They're not conventional investors that you would typically see in a conventional offering like a regular Reg D or a regular Reg A plus. So the token will only succeed in its offering if it appeals to those people that are likely to buy it, and they tend to be a group of relatively technically techies, basically, people that are were really early adopters in many cases of blockchain and Bitcoin in many cases, who've made a lot of money, maybe didn't intend to, and in a way they're investing with house money that they've made as a result. And they're also looking for very exciting technological developments that further what can be done, and not very interested in simple commercial offerings. So there are a number of instances of ICOs that were well promoted, that were genuine and legitimate with real teams behind them, where they were too focused on appealing to conventional investors, and they failed dismally because their token just didn't resonate properly with the audience. So that's one whole issue. The other issue, which is very interesting to me, is that when you come up with a concept that resonates beautifully with your business, and it essentially could be successful as a utility token, where it's something that is inherently expanding your company's and its presence and the services that you deliver, at this point in time, it may be easier to promote that and get adoption by all the players involved by making it an ICO and having them buy it and then resell it in the aftermarket to others that are more interested, again, in participating. So I'll pop back out from that and go back to question and answer session. Go back to the questions, and Sarah, go ahead, and I'll look through and see if there are any that are not just legal.
So there's a couple of questions about exchanges. Probably, we have not seen the SEC or state authorities take any action by reason of a company seeking a listing on one of the exchanges. However, from the exchange's point of view, if the exchange is within the jurisdiction of the SEC and they are not registered as a broker-dealer or an alternative trading system, which is like a stock exchange light, they may well be breaking laws themselves. Now, we haven't seen anybody put those two things together and say, if an issuer goes onto a non-registered exchange that should be registered, that they were holding the issuer responsible for that. Could happen. I don't think the SEC feels it needs to at the moment, because there are enough things that they can tell the issuer off for in the first place. But the basic principles that we're dealing with here is anybody who puts together buyers and sellers of securities may well be a broker-dealer. And any system that puts together brokers, buyers and sellers of securities may be an exchange. And anyone who does that should consider whether those regulations apply to it.
So let me answer this one. Sorry to interrupt. There's a question here, essentially from a company that is seems to be doing an ICO already, and they would like to convert it into a utility, and they're asking, if we now convert it into a genuine utility token, will it stop being treated as a security? And I'm sure Sarah can add to this, but I would say that if it was a security, you should separate the two and figure out a solution to the problem you have with the first one. If you had a problem with the first one where it was a security and had all the characteristics of a security, make the new one a separate entity or a separate token so that you can deal with it successfully. What would you say, Sarah, about how that company could go back and fix the problem with having done the initial security token, presumably without having done a regulation, based on the way the questions are?
It is extraordinarily difficult. The solution to doing an offering that should have been registered and wasn't registered or could not fit within an exemption, the solution to that is a rescission offer. And a rescission offer is the company goes back and says to everybody, yeah, we sold you this stuff, we shouldn't have done that, please give it back to us. The problem with rescission offers is that they must be made themselves in reliance on one of the exemptions. So if you did a failed Reg S, and I've been dealing with some of these recently, if you did a failed Reg S offering, you can't sort of undo it by doing a Reg S offering that doesn't comply equally. And as I said, Regulation S requires certifications from people, including not just people who are going to give you the securities back, but people who are going to continue to hold the securities. So it is a huge challenge to put together a rescission offer, and I'm not sure how successful it will generally be.
Sarah, could you reboot your video, because your video's gone blank?
I will.
And while you're doing that, I'll look up questions that I can address successfully.
Yeah.
I'm just scrolling through the list here. There's some. Oh, there you go. That worked very well, very quickly. There's a question here which is more technical in nature. If an ERC20 contract, ERC20 is the system which Ethereum uses to create new tokens for initial coin offerings. If it doesn't work, how do you tokenize a security to make it work on the blockchain? That isn't something we can really address in this session. We're not focused on that type of question. But at the end of the day, you're going to have to find a solution either with Ethereum or with one of the other competitors to Ethereum that create tokens for ICOs.
Yeah, if I could add to that, Rod, I mean, we've seen the limitations of ERC20, and some companies have terms and conditions that are on top of the actual smart contract, and that's where you could put the customizable stuff in, probably. But then that means that the smart contract itself becomes much less of an, it doesn't exist on its own. You've now got the smart contract, and there's like, by the way, there's also terms and conditions, and you lose some of the advantages of a smart contract. The whole point of that is it's immutable, and if you've got terms and conditions that you can change, it's like, oh well, this bit is immutable, but everything else can change. Yeah, that's kind of a work in progress.
So one thing I want to add to that, which for the audience's benefit, is that essentially when we make a compliant ICO, then we are making sure one of the things that has to be done and really has to be tested in QA to make sure it's delivering is that the compliance restrictions that the offering will deliver on have to be built into the token software and to the smart contract, so that when push comes to shove, it will deliver. And it's turning out that some of these restrictions are a little simpler than they first seem, at least to my eye. But that's where you have to make sure it gets delivered. I'm looking down this list of questions. I don't know whether are you seeing fresh questions there, Sarah?
Yeah, I can see some. There's a sort of series of questions here about the SEC process, and so okay, the SEC process for Regulation A is you file an offering circular. Somebody's correctly pointed out that it's possibly more complex than a mere white paper. A lot of the information that's in a white paper you can use in the offering circular, but bear in mind, if you're going through the SEC, you're not going to be able to be anonymous. You're going to have to say who is the team who is developing this thing. You're going to have to identify the company, who owns it, and who's running it. Those are the things that we frequently see that aren't in a white paper but are in the offering circular. And then risk factors. I've seen very varying quality of risk factors in white papers. I don't think you need hundreds of pages of them, but there are some things you do need to point out that we sometimes don't see in the white papers. When you file with the SEC, this is the way it goes. They have 30 days to get back to you. It's usually they get back in about 26 days with comments. You then respond to them. They have 10 business days to get back to you with further comments. You respond to them, and then they've got 10 business days again. Usually as you get further along the process, the comment periods get shorter because they're going to have less questions. But you should, if you're going to go through the SEC process, for Reg A, you should budget 4 months, both for putting together the offering and then getting it through the SEC. Unlikely that you'd ever get it faster than that. There's also,
actually go ahead, Sarah. Sorry.
Yeah, and the other things people have noticed that you file Form D with the SEC. Form D is just a, hey, we sold some securities. The SEC doesn't review it. The SEC doesn't interfere in the process. And then Regulation CF, when you file that with the SEC, it's much shorter than a Reg A offering circular. And again, the SEC doesn't review it. You file it, and then who reviews it? Probably securities regulators in the States, possibly plaintiffs' lawyers, who knows? But the SEC does not have to sign off on it.
So there's a question here about the costs. So let me touch on that. Again, all of this is a fast-moving target. The cost of promoting ICOs has increased dramatically. The cost of various parts of them are also increasing in the sense that there are not the people that do the smart contracts and the token software are in short supply because a lot more people are doing ICOs now than in the past. So whilst that isn't a rocket science kind of work, there are still a limited number of people that have practice with that. So it's easy to pay too much money or to pay a lot of money or to have to wait. I know of a law firm in Switzerland that has a 1.5 year backlog of ICOs. Obviously, that's going to self-correct in one way or another. But in terms of costs, let me give you this guidance. There are many people in this webinar, I expect, that are, I know, that are attorneys, and I don't want to interfere with their business, but essentially to do a Reg A plus, the low end cost is going to be 50K, and it can be higher to get the legal compliance work done for the SEC filing. And you have the cost of the token software development and a smart contract, and that's going to vary immensely depending on whether you have it done by your own employees or where they are and so forth. But 6, 8, 10, 12, 20K, 30K, you know, I've seen silly numbers, but you should be able to get that done. It depends so much on really what is being done by the token, but at the low end of the range, $6,000 might be doable for the technical side. But this is so inherently a part of your business that you shouldn't take a general number for that. The marketing cost, staying with the Reg A for the moment, and again, the cost of marketing are rapidly changing. It's higher in the US generally than outside the US. But my guideline for you is to, you kind of have, not looking at holistic offerings which have kind of a front-end priming mode and then they catch on and resonate and go non-linear and raise huge amounts of money. There's no real percentage analysis one can give for those. But in a Reg A plus environment where only a reasonable portion of the proceeds of the offering raised itself, once any minimum has been exceeded, can be applied to the marketing of the offering, then, you know, cash flow matters, front-end funding of it matters greatly. Probably you're going to spend 20,000, 40,000 at least in upfront marketing costs to get ready, and then my guidance to you would be about 4% of the raise in a linear raise, which means, you know, 10, 20 million dollars, not 200 or 300 or 400 million, which if you get lucky might occur because then the percentages don't generally apply. In a Reg D scenario, the legal costs will not be as much lower as they would normally be because this is more complex stuff and more hoops have to be thought through, more jumped through. So probably the low end of the legal range is 20 or 30K, and it's generally going to be more than that, more like 40K or so for legal costs to make it a securities compliant Reg D ICO. You would want to include Reg S for the non-US investors. And then the marketing costs are going to be much higher in the US for getting through to accredited investors, and generally lower if you use Reg S. But Reg D is what I meant to say in the US, or Reg S outside the US, because you don't have to, the investors don't have to be accredited. So think 4% across the board as broad strokes what the cost will be. It might be significantly higher. In a conventional Reg D, it could easily be 8% marketing cost. Something else that's important to understand is that in a Reg D, because the US investors are sophisticated, then a large portion of the capital raised, once any minimum has been exceeded, can be applied to marketing the offering, which is a big advantage in Reg D that you don't have in Reg A+. It's also faster to get all of the legal work done in a Reg D, and you can use a convertible note, or i.e. SAFT, to bring in money on a loan basis for the creation of the token before you have built it. So you have versatility there that you don't have. That's why you'll see more Reg Ds being used for ICOs than, but you'll just see them being used because they have that appeal. Do you want to add to that, Sarah? I think probably you want to answer other questions.
Yeah, I think there's some very interesting questions coming through. There's a couple of questions right about the whole using Reg A for SAFTs. I think you could use Reg A for SAFTs. The trick here is that when you're going through the SEC process, if you've got a convertible security, the SEC requires you to file for the thing that you're offering and the thing it is convertible into. And so we all know that the SAFTs are like, hey, we're doing a thing and it's going to have maybe these attributes, and when we get to do it, you get to share in it. And that's pretty easy to describe. But the underlying security, the uncertainty of the token when it's developed, that's going to raise some issues with the SEC. Doesn't mean you can't do it, but if you file under Reg A for a SAFT, be prepared for the fact that they want both layers of securities. The thing and the thing it's convertible into have got to be described. And if you don't know what the thing is, it's going to be prepared for a very long process. So that's a thing about SAFTs. I don't know if there's any other SAFT things you want to add there for the Reg A, Rod?
No, that's good, Sarah. I wasn't really thinking about using a SAFT for Reg A plus at all. But the point is we do need to avoid complexity, because what might be a 90-day journey through the SEC could be interminably long if it's way complicated. And being an ICO alone is complicated enough at this stage in the game, I think.
Yeah, I think it's, if you do it that way, be prepared for a very long journey with the SEC.
There's a question about bounty programs where people are motivating others to promote their offering, which is scary stuff. If you're doing a securities transaction, you can't just have people where you're paying them to market your offering to investors. I'm sure Sarah can add more to that, as is the case with most of these things. But actually, I'll let you answer that.
The other thing about bounty programs, apart from the fact that the issuer has to find an exemption to fit into, by compensating people for promoting your offering, you've made them into stock touts, and they are now subject to Section 17B of the Securities Act, which is very, very broad and very easy for the SEC to enforce. And to the extent you've got Drake or Floyd Mayweather or Paris Hilton out there touting your coin, you have now made them into stock touts, which they are not going to be happy about. And those guys are now liable for disclosing what they're being paid, how they're being paid, and who's paying them. And if they don't do that, they've violated Section 17B, which is a violation of the Securities Act, and is going to get them into trouble. And they'll be very unhappy if that happens to them. So don't do that without, again, getting securities law advice. The other thing that you may run into is, depending on the level at which you're compensating them and the manner in which you're compensating them. If you're saying, well, for every 60 investors that result from your tweets, we're going to give you, $50, more tokens, you've just made them into an unregistered broker-dealer as well. So they're going to be super unhappy with you. So be careful with your celebrities when you're doing this stuff.
One of the questions here is, if you put in the terms and conditions of an SAFT that the investor confirms that they are accredited, is that sufficient? And the answer is, it depends. So if it's a Reg A plus, then that is sufficient. The investor can self-state their accredited status, but in a Reg D, they may not. In that case, because the only way of doing a Reg D online is a 506C variant, in that case, it's incumbent on the company raising money to verify the accredited, to take reasonable steps to verify that the investors are each accredited, not to take their word for it alone. There's a question also about Reg D, the 500 investor limit from Section 12G. and saying, well, if the company's listed, doesn't that solve the problem? Well, you can't use Reg D as a method to list the company on a major exchange anyway. So you have to use one or other registration system to list the company. And if you are going to the NASDAQ or the New York Stock Exchange, which is a bridge that hasn't yet been covered, or crossed, I should say, in an ICO, but will be, then that's okay, because you're taking care of the very thing you're worried about in Section 12G, which is having to register the company as if it were a fully public reporting company. I don't know if you want to add to that, sir.
No, that's exactly right. I mean, the 500 holder of record trigger is the thing that says if you have 500 equity holders of record, then you have to register with the SEC. Obviously, if you are registered, yeah, the SEC's gone away. I can foresee some very interesting conversations with NASDAQ, who is very nervous about anybody who's got bit or blockchain or anything in their name. We're going through that with a company right now, a Reg A company who's going on to NASDAQ, and NASDAQ they're super focused on anybody who has who mentions Bitcoin, any crypto, any coins, any tokens. Yeah, expect them to do an awful lot of due diligence if you're one of those companies.
Another question is, if your token gets listed on an exchange, how does that change your status in the eyes of the SEC? Well, if your token wasn't registered with the SEC and you're selling it in the aftermarket in the US to US investors, then you've got a big problem. You have to prevent that. You can't sell your token to US investors in any scenario unless it's genuinely a utility token, in which case then probably it doesn't make sense that it would be on an exchange, really.
But if you possibly what they're talking about, like a token exchange as opposed to a stock exchange.
Yeah,
I can't tell from the question.
Yeah, I guess my point would be that if the SEC approves of US investors, when the token security is registered with the SEC and is liquid as far as the SEC is concerned, then the US investor should be selling it if they're selling it in the US, they should be selling it through an exchange that is approved by the SEC. It gets more confusing and more generally vague outside the US, but for a US investor buying or selling inside the US, they should be doing that on a US approved, SEC approved exchange. I don't think there are any yet, but there are two coming soon. What do you do with a restricted security at the end when you raise money using a Reg D? Probably the question really means, you know, is this restricted? Yes, it is. What can the token owner do with it? Essentially, a Reg D purchase would generally be a US investor, and they are not able to sell that token to another investor until their Rule 144 holding period has passed. But I'll ask Sarah to shed more light on that.
It's a really interesting question on the resale of restricted securities, because if you're holding restricted securities, so you are an accredited investor, I'll give people the context here. Regulation D, you sell to accredited only. Those people are now holding restricted securities, and a restricted security is one that you cannot easily resell. Can't sell it to the public because you get treated as if you were the issuer itself, so you need an exemption for that. You register or find an available exemption, but you can sell privately, so you could sell to another accredited investor. You're going to need to do a couple of things in the smart contract if it fits, and I'm really not sure that's going to depend, or in the terms and conditions. You are going to have to make sure that the smart contract is coded such that you know how long it has been since the company sold that security. So the period, which is 1 year, during which securities can't be easily resold, is measured, and then at the end of that, you know, okay, now this is free trading. And if you are able to, you're going to need to have some mechanism of making sure that people don't resell to the public. And so that's a coding thing. I mean, it's not a securities law thing. It's just like, hey, person who's writing the smart contract, put this in, say how long this restriction applies for, and make it so that it cannot be easily resold. One of the things you might consider doing is just saying, hey, can't be traded for a year. That would be easy.
Something else to bear in mind with this is that if the security, or if the token was issued subsequent to an SAFT, that 1-year holding period starts when the token is first issued, not at the beginning of the SAFT. That's probably apparent. Is it possible to use Reg D and Reg S for foreign investors? Absolutely. That's a better way to go than just Reg D everywhere, for many reasons. So Reg S, you can do a combined offering that is Reg D to US investors and Reg S for international investors, as long as you make sure that is the case, that they are not US investors masquerading as non-US investors.
And so long as you make sure that the Reg S portion does comply, so that means behind a firewall, not available to US persons.
But so can you define firewall, Sarah, in that context?
So what you would want to do in order to fit within the safe harbors of Regulation S, which is the only way I would really recommend going. And we can get into the metaphysics of Reg S if anybody wants to talk to me about it. I wrote it back in the late 80s, early 90s when I was at the SEC. But the Reg S has safe harbors which say this is, if you comply with these conditions, you are for sure outside the United States. One of those conditions is no sales and no offers or sales in the United States. No offers. Because remember, to go back to one of the things I said earlier, offer, very broadly defined. It would include having a website available to people in the United States that says, here are, these things are for sale, but they're only for sale to US persons. So you would want that screen only to be available to people behind a firewall, and that firewall should, number one, bounce anybody with a US IP address. And yes, I know everybody uses VPNs. I use one myself, but yeah, we do the best we can. And then number two, when they want to get into that site, they positively affirm in person, as a named person, that they are not a US person. Very difficult to do Reg S on an anonymous basis, to be honest. Very difficult to do both of those on an anonymous basis.
So correct me if I'm wrong, but I want to clarify this for our audience. If you have a combination offer, then the Reg S metrics should not appear to a US investor. A US investor should only see the Reg D metrics, i.e. the minimum, and that they need to be accredited. They shouldn't see this other tantalizing opportunity on the offering page that talks about what it would be if they were a non-US investor.
Right.
Right. Okay, that's good, very, very good information. Let me look at the list here. So we're just past the hour, or right at the hour now. Is there a possibility that the SEC may go after the ICOs that they missed? Of course, who knows what they will do. One interesting thing to bear in mind, I think, here is that part of the reason there's so much interest, part of the reason that ICOs took off last year was because of the rapid appreciation of Bitcoin. Not to say that one didn't fuel the other, they both fueled each other, but if Bitcoin was still priced at the end of 2017 at the same price it entered the year at, I think we'd have seen a lot slower progress in the ICO community. They're separate variables. What Bitcoin trades at is immaterial to whether or not an ICO does a good job and this makes a successful transaction. But my take on the recent decline in value of Bitcoin is that if this ends up meaning that in a very short space of time we've gone from blockchain 1 to blockchain 2, where this is the second version of it, and people are going to be more conservative and balanced in their view of ICOs, so be it. That would be great to get it done with already. Valuation of a token seems very problematic. It's problematic in general. We just read the question rather than stating it all. What might the disclosure requirement be relative to the valuation of the token in the ICO and later? Talking about valuation. Good question. I don't know. I don't have much to say about the valuation of a token, except that you shouldn't be promising in any case ballistic future returns or future returns at all on what the investment might perform. Do you want to comment on that, Sarah?
Yeah, I mean, you're always going to want to have risk factors that say, in effect, look, this is a pretty random number that we're assigning to this, and you will, in the case of Regulation A, you will always need to have financial statements that you hope would indicate whether or not the security you're offering is worth what you're offering it for, which of course is not going to be the case in ICOs, because they're going to be brand new things. So it is very much going to be a here's what our financials are, which are probably like nothing. Here is the risk factors that say this is how we calculated it, and the market will make up their own mind. So this is where the SEC does not get involved in issues of market valuation. Thank goodness.
One thing we will see is that as the mix of investors, of the buyers of ICOs adjusts from who it's been to more conventional investors who are investing for return, then we'll see more conventional metrics come into play. So it's been there's been a lot of hype, there's been a lot of extreme overindulgence and a lot of bad practices in many cases with ICOs up until now. I say bad practices in a specific sense where they haven't been behaving in a regulated manner or in ways that would fit within regulations. So the truth is that as the investors become more normal, then the valuations will become more normal. One of the questions is, can a company issue a security token and a utility token both? And of course, the answer is yes. It can be challenging from a simplicity point of view to make that work, but yes, that's a very legitimate thing to do.
I've got a couple of answers to a couple of technical questions here, Rod. Somebody has pointed out the trigger for SEC registration requirements under Section 12G. We were referring to 500 investors. Very correctly, someone has pointed out 2,000 holders, no more than 500 of whom can be non-accredited. Absolutely correct. The reason we're using the 500 is that you are just in an anonymous blockchain situation, you're just not going to know if those people are accredited or not. So unless you have somehow coded everything as to identify accredited persons in the initial offering and to whom they transfer on the blockchain, really effectively it works out as being 500. And then another technical issue, tacking of the SAFTs, the 1 year holding period. Yes, the tacking period would start when the SAFT is issued as opposed to when it's exercised. That clearly came.
Sarah, can you clarify that? Because I thought that the token, excuse me, if there's an SAFT involved that then later converts into a token that is a security, you're saying that the 12-month holding period for the security starts when the SAFT is purchased, or when it is? Okay, that's the opposite. I got it wrong earlier.
Yeah, what the SEC is measuring is how long the money's been at risk. So if you put the money up, now of course, different considerations at all if you have to pay more money at the time of exercise, but most of them don't work that way. So if you put your money up with the SAFT and then the SAFT converts in accordance with the algorithm set out in the SAFT, then the tacking period applies.
So something else I want to clarify is that given the practice in ICOs of offering discounts for early buyers, that is it's easier to deliver a similar equivalent in Reg D than it is in Reg A plus, because it's easier to essentially have a series of valuation steps in Reg D than it is in Reg A plus. In Reg A plus, as long as you avoid exceeding a 20% valuation change cumulative in the steps that you make, then it's a relatively simple change. But if you exceed 20%, then you have to go back, and it might take a longer time to get approval from the SEC. Not that they're worried about the valuation issue itself, but that they require that, and that's the way that they're dealing with it.
Yeah.
So essentially my point there is it's easier to do a series of steps in price for the security in a Reg D transaction. Is it possible to sell a token in the US as a security under Reg D, but as a utility outside the US? That could be very confusing because, actually, I'll ask Sarah to address that too. I don't think I have a good answer for it.
I think that's the answer. It's rather confusing. I mean, I think the thing is, it's going to depend on the laws of the jurisdictions into which you are selling. I mean, the SEC, what it treats as a security could be completely different to what Singapore or Korea or somebody else treats as a security. So it will always be on a case-by-case basis. And you could certainly have something that the US views as a security under its laws, and that another jurisdiction's like, hey, you know, we have no jurisdiction over that thing. It's not something that we regulate. Could certainly happen.
A couple questions I want to try and answer quickly. I don't remember offhand the names of the two SEC, the two exchanges that intend to be SEC approved. One of them, I just have this overstock.com, right? Yeah, overstock.com is doing their, pardon?
T0.
And T0. So there are two coming, and I keep forgetting their name. But it'll be evident when they're actually SEC approved, because they'll make a big noise about it. Under Reg A plus, can the tokens be listed on cryptocurrency exchanges, not during the selling process, but after the issuance of the tokens to the investors? Then they are allowed to trade them in the aftermarket, and then they will typically be resold on cryptocurrency exchanges, because that's the only easy place to do so.
And we go back to the question we answered before, which is, you know, those exchanges should make sure that they comply with the registration or regulations of wherever it is they are operating.
Right. So if it's US, then they have to be SEC approved. Yeah. So can you issue under Reg D and resell under 144A restricted to QIBs?
Yes.
Mm-hmm.
Yes, you can.
Yes, so that's a small sample of the audience. What's a QIB when it's at home?
Qualified institutional buyer. I mean, 144A is it was a rule which I also, by the way, wrote that permits the trading of securities. It was intended to address the trading of Eurobonds, basically, but very large securities being traded. But yes, you absolutely could issue under Reg D and resell under 144A to QIBs. Those are guys, you know, they've got 100 million in securities. So, yep, can do that.
So good question here. Can a website have a Reg D button and a Reg S, but the Reg S only shows to foreign IPs, and that's the way to go, I think. Yep. To foreign internet addresses, then they get to see, non-US internet addresses get to see the Reg S option, whereas US internet addresses do not. What is the benefit of a US company offering an ICO given all the complexity? That's a great question, and it's also a fast changing one. You know, there are companies that I see, some of them would be better off doing a conventional offering, because of the nature of what the token would end up being kind of boring to the ICO community of current investors. So occasionally I'll advise a company they'll do better to do a traditional offering than an ICO, because sometimes it just doesn't fit, and it is more complex, and it is therefore more expensive and more time consuming. The reason, I think, probably, the primary reason for people leaning towards ICOs is it looks like a much easier way to raise large amounts of money. And there are instances where that's clearly the case. And, will that be a long-term phenomenon? Probably not. But for the time being, it is, where it can be made to fit properly. You literally, the token has to make sense for the company, and it has to be appealing to the investors one is marketing to, or that have a propensity to buy into an ICO. And that is currently an unusual mix. Will change with time, and is changing as we speak. Under Reg D, if someone transfers the token to a non-accredited investor, does the ICO company have to take any steps, or is the transferor liable? Over to you, Sarah.
It could be that under certain circumstances that the person could be treated as being an underwriter under securities law, being involved in the flow of securities from the issuer to the investing public without a registration, so that is possible. If the issuer took steps, and we talked about this before, coding into your smart contract a way to prevent or try to prevent or limit and make sure that people know what the restrictions are, issuer should probably be okay in those circumstances. Set it up properly from the beginning is the answer.
So I'm not seeing more questions. I'm not sure if you are, Sarah. Maybe that we have as many questions as we're going to get, in which case we'll wrap here. The time is, what is it? 12:13. So Matt, are there questions that I'm not seeing? I don't want to keep us going here without questions, obviously. We've covered a lot of ground. Actually, we've been online for an hour and 15, which is what roughly we intended. I see that cue, Matt. Yes, I do. Yeah, so I think we've covered the ground, guys. There's no point staying online here any further. Thank you very much to the audience for participating here. I hope this has been very helpful to you. Thank you, Sarah. You're such a great expert in this field, and you're English too. Let's face it. I appreciate that as well. So anyway, thank you so much for being here and helping, not just helping, And thanks to Matt and Orson and our team at Manhattan Street Capital. And we will be posting this video recording with an index as soon as possible, which probably means a week or two. We'll send an email to you guys to notify you when it exists. This time around, we have two recordings going on, so one of them should work. And I would have thought that would have been fine last time too. And encourage you to follow up with questions to us at Manhattan Street Capital and to Sarah that you may have following. You can see our names, and the links were posted earlier on in the main chat. So without further ado, I think we'll be wrapping in a moment. Thank you, everybody.
Thanks for the great questions.